Well, as promised, we have an expert to talk to us about this. He's Craig Alexander, former chief economist at TD Bank and president of Alexander Economic News. First of all, thank you for coming in and helping us. Your thoughts on this what looks like a big beat?
Well, it is. It's a strong report. You know, anything above the 25,000 mark, I would say, is a solid gain. So the fact that the Canadian economy delivered, more than 30,000 jobs and double what the market was looking for is unquestionably strong. The one caveat to that is it is a positive development that the wage growth moderated to 5.3%. The Bank of Canada might be surprised by the strength of job creation, but they'll be pleased to see that the pace of wage growth is moderating because they've recently signaled that that's one of the things that they're paying acute attention to.
Mm-hmm. Does this make it more difficult for the Bank of Canada to cut its benchmark interest rate early in the second half of this year?
On balance, I'd say yes, it does, but I think it's just one monthly data point, and we'll see. I think the market expectations had shifted back to looking at the Bank of Canada maybe cutting by June. We'll have several more employment reports by then. The bank is going to want to see wage growth continue to decelerate. I think they actually would like to see wage growth down near 4% based on where productivity is in Canada. So as a consequence, this is one data point. It is stronger than expected. I think it is consistent with the other high frequency indicators we've been getting, like the GDP numbers that also beat expectations just recently. So it does look like the Canadian economy has a little more momentum than the Bank of Canada has been forecasting. And on balance, it might make them think they need to give monetary policy a bit more time.
And on that note, following on the other economic indicators, towards the end of last year, things were slowing down quite significantly, and now we're getting a bit of a bounce. Does it look like we're going to be able to avoid a recession and maybe just have the soft landing or bounce around zero?
Yeah, I think that it's really what you said at the end. I think that really the economy is bouncing around. It's staying in positive territory, but it's staying close to the zero mark. When we got the first reading of Q2 economic growth, it was a negative number, and then it got revised up. But the third quarter posted a contraction. The fourth quarter is now tracking towards growth of around 1%. So the Canadian economy looks like it keeps avoiding the technical criterion of back-to-back quarterly declines for a recession, but we're really hovering around the sort of close to flat reading. So really, I think that the economy has largely stalled.
I want to tell viewers more about these numbers. The job addition number, again, is 37,300. That is the result of many additions and subtractions to the Canadian labour force over the month of January. And I can break that down a bit for you. There was a loss of goods-producing jobs of 23,000. There was a gain in service-producing jobs of 60,400. So effectively, all the jobs were service-producing jobs. Within service-producing, there was meaningful gains in retail jobs, an addition of 31,000 jobs and change, transportation jobs, an addition of 20,000 jobs, and jobs in finance, an addition of 28,000. Again, the end number of 37,300 is the result of gains and subtractions just like these. And Craig Alexander, there was a huge increase in public sector jobs of 47,600 and an addition of private sector jobs of only 7,400. How should we think about that big gain in public sector employment?
Yeah, well, the split, it looks like it's a little less favorable for economic growth. Public sector jobs don't add to the growth in GDP the same way that private sector jobs does. So, once you cut one level below the headline, the numbers are a little less favorable in terms of economic growth.
Where does the Bank of Canada want to see wage growth?
I think that they'd like to probably see it down around 4%. I mean, the economy can support stronger wage growth if we get stronger productivity growth. The problem is that Canada's productivity performance has been terrible. Now, there are some preliminary signs that we're starting to see some improvement in productivity. And if that continues, then we can support wage growth probably around the 4% mark, which is still like more than a percentage point below where we are today. And when we had the minutes from the last Bank of Canada decision released just the other day, there was a there was a good section talking about how the governing council was looking at the labor market, and they clearly identified concerns that the pace of wage growth that we're currently having is going to make it harder to get back to that 2% mark on inflation.
Go ahead, Colin.
Paul had mentioned that one of the areas that had significant growth in January was retailing, which was quite interesting when we think it's often the slow time of year for retailers. Is that a good sign for Canadian consumer spending? And how are we thinking on the health of Canadian consumers right now?
Yeah, I always a little cautious when we're looking at a single month's worth of data because it's so incredibly volatile from month to month. I think that the general picture is that the Canadian consumer has moderated its spending. Now, one of the things that's distorting the picture a little bit is the fact that we've had strong population growth. And that strong population growth is helping support economic activity. But if you actually look at spending on a per person basis, like a per capita consumer spending, it's actually been contracting. So the signal there is that Canadians are definitely feeling the impact of the higher interest rate environment. I think that many consumers that have had their mortgages reset or are looking at mortgages resetting in this year or next, are being a bit more cautious on their spending behavior. And again, this is the sort of thing that the Bank of Canada is looking for. When they raise interest rates, the entire mechanism through which they cool inflation is by dampening demand. And so what they want to see is they want to see consumer spending moderate, but they don't want it to collapse such that we get thrown into a recession. So we're really ending up with the good outcome in terms of we've had a big tightening of monetary policy, and what's happened is the pace of economic growth has stalled, but it actually hasn't gone into the typical, significant downturn that you run the risks of when you're in a monetary tightening cycle.